Hi, good morning. Uh, Let us today discuss about capital budgeting and investment decisions. Capital budgeting and investment decisions on CMA is a separate section in which we'll be discussing the topics about how and when a capital investment is made and what techniques we use in selecting the projects which need huge investment. What is capital expenditure? What is operating expenditure? What is the difference between capex and opex? Different techniques used in selecting the projects, time value of money, cash flow calculations, and risks in investment decisions. These are the topics we are going to cover in this section. First of all, what is a capital budget? Capital budget. Before you talk about capital budgeting, let us talk about capital expenditure and operating expenditure. Capital expenditure means an amount which is spent to get the benefit in more than a year. Like you purchase a car, you purchase a car or you purchase a truck to be used in the business. Obviously, the benefit you get from the purchase of car is more than a year. That is called capital expenditure. But when you fuel it, your truck is fueled, your car is fueled, that is an operating expenditure. Operating expenditure goes to the income statement as and when you spend. As and when you spend, the operating expenditure will go to income statement. It will reduce your income in that period. Say you have repairs to a truck. You spend some amount on repairs. The repair expenses are incurred in the month of October. In the month of October, you will have these expenses in your income statement. But you purchased a truck in the month of September for $100,000. We do not charge entire $100,000 to income statement in the month of September. Why? In my previous example, a fuel used in a truck is consumed and the benefit is received from the amount you spent. Therefore, that has to be expensed. That should be charged to the income statement. But in the second example, that is the purchase value of the truck of 100,000, you get benefit during the life of the truck. That is more than a year. Obviously, a truck will give you service more than a year. Say the truck's life is 5 years, 100,000 is the amount spent to get benefit in 5 years time. Therefore, the amount you spent on purchasing the truck of $100,000 is called as capital expenditure. To recognize whether an expenditure is a capital expenditure or revenue expenditure, the best criteria is the benefit which you receive is less than a year or more than a year from the outlay of cash. When there is a cash outlay, the thumb rule is every outlay is giving you a benefit within a year or more than a year. Within a year, operating expenditure charged to the income statement. Greater than a year will be called as capital expenditure. Therefore, it will be amortized during the life of that payment. So in my example, 100,000 truck has a life for 5 years. Therefore, this 100,000 divided by 2, that divided by 5, that is 20,000 a year, will be charged to the income statement as depreciation. The remaining portion of 80,000, that is net book value or carrying value, will be shown under balance sheet under fixed assets. So what our topic is about? Our topic is about to take a decision whether this truck is to be purchased or to be hired. Say for example, the truck is hired for $4,000 a month. $4,000 a month. So to avoid this, we will own our truck, but it needs some money, $100,000. So this $100,000 we're borrowing at the rate of say 6%. So obviously you need to get the benefit by purchasing this truck more than 6%. Or here, let me explain you that you are paying $4,000 as rent, and here $100,000 you are borrowing at the rate of 6%. Okay, $600, $6,000 is the cost. So your monthly amount will be 500. Here monthly expenditure will be 4,000. Not only that, you will have depreciation of 20,000 per year. So 20,000 plus 6,000, you will have an expenditure of 26,000 per annum. Here you will have 48,000 per annum. So you'll have to take decision based on this analysis whether it is to be purchased or still we need to continue with the rented asset. We take decision by studying this way. Always the benefit should be higher in making a decision. So if the analysis says there is a benefit, accept the project. Otherwise, reject the project. Whether to accept or not to accept, we know the thumb rule, but how do you calculate these issues and all, like what amount of saving we are having, what is an opportunity cost we have here, etc., etc. We'll study in detail now. So capital budgeting is a technique used in evaluating and selecting from the alternatives available in the investment. The investment can be in purchase of land, purchase of fixed assets, launching a new product, opening a foreign branch, or launching a heavy advertisement campaign, or having our own factory building, anything which requires huge money and the benefit you receive is or greater than a year. The motives for capital expenditures, like you are spending huge amount, but what motivates you to spend that much money? It can be towards expansion of the business, the product expansion or geographical expansion, replacement of old machine or new machine with an old machine. So old machine will be removed because that is giving you less performance, so it will be replaced with a new machine which requires huge money. Renewal of licenses, like you have a franchise right, you have copyrights, patents, etc. To renew them you need huge amount of money. Any other purposes, like I said, launching of a new advertisement campaign which requires huge money, and the benefit, because it's a brand management, it requires huge money, and obviously the benefits you will receive in more than a year. So it also comes under capital expenditure. The steps in the capital budgeting process includes, first of all, you need to generate a proposal that we are going to construct our own factory building, for example, because we are in rented premises. we have financial and non-financial issues that we are facing having a rented premises. So generate a proposal that we acquire land, we construct our own factory building. That's a proposal generation. Review and analysis that what amount of savings you will have, that you will be no more paying the rent, taxes, etc. And you see that how much will be the savings having our own factory building and how much money is required to construct our own factory building. What is the cost involved in that? What is our opportunity cost of that investment? Using this review and analysis, we use different techniques like payback period, internal rate of return, average rate of return, etc., etc. That we'll discuss later. So after having a detailed analysis, we make decision, we take a decision to accept the project or still we need to continue in the rented premises. Decision making. Once you take a decision that yes, we are going to construct the factory building, implement it. Implement it, start constructing it. So you will have cash outflows. And at the same time, post audit. Post audit means follow up whether what we reviewed is happening or not. That is post audit. So in the capital budgeting process, mostly you need to concentrate on second and third, points. Second point is like what is your opportunity cost, what is the investment required, what benefits you have, what financial non-financial benefits you have, what are the risks involved in that, etc. We analyze in unit point number 2. Point number 3 is our syllabus, you can say, that is decision making. While making the decisions, which technique is to be used for which project. So we'll have 5 techniques here. Based on the criteria, acceptance and reject criteria, you will be selecting the projects which are um, feasible for us. But before that, you will be having cash outflows, cash inflows, etc. in second point. That's the reason why I mentioned here our focus should be on steps 2 and 3. We can say even entire our this unit is based on these two sections, two steps. Okay. Post investment audit, like I said here, follow up. Just by implementing a project is not enough. You should also have a post investment audit which compares what actually we expected, that what benefits we expected from having our own factory building in my example, and what actually is happening. That is called post investment audit, so that it provides a good feedback to the management about the performance of this project. So in the post investment audit, we should always see that whether a particular investment decision is profitable or not profitable. If it is profitable, of course the management involved in that will be recognized, and some uh, there will be some rewarding rewards will go to these people. Therefore we need to have a post investment audit with a favorable and unfavorable variances. Variance means a difference. If this variance is not much significant, in a sense the variance is not much different, then obviously it has to be ignored because it is within the tolerance level. But there is an unfavorable variance, the individuals and the teams, the management, etc., who involved in the you know the project should explain the reasons for the variance. That's the reason why post investment audit is very, very important. And in most of the cases here, we are taking decisions, and for the to accept or not to accept a project. So we need to define a cost which is going to be incurred once you take a decision to accept a project, that will become sunk cost. In fact, sunk cost means the cost which is incurred in the past. Once you incur this cost, it is irrelevant whether you continue the project or discontinue the project. That is the reason why a sunk cost is an avoidable cost. Unavoidable cost, therefore, will have to take care of it, because once it is incurred, you cannot take it back. Say, for example, I said factory building. You constructed your own factory building, but you are not getting the benefits what you expected. When you are running your factory in a rented premises, it was good, but which you came to know later. By the time the amount spent on construction of the factory building is is an outflow from your business, that becomes sunk cost. So, A, while accepting or rejecting the projects, you should also consider the relevant costs related to the acceptance of the project. Say, for example, a factory building is constructed. So obviously, you may have to buy some other, some other land to have a pathway to your factory building. There might be some taxes involved, etc. You need to check whether there are any avoidable costs or there unavoidable costs are there. Also, at the same time, you need to talk about opportunity cost, which is very, very important in capital budgeting techniques. Opportunity cost is the benefit that is foregone by not accepting another alternative. Like I said, you are paying a rent of $100,000 for $4,000, and you are investing say $100,000 to avoid that. This is going to be avoided, but you have an opportunity to earn on this 100,000. What is your opportunity? That depends upon individuals, ability. Say I may earn 9%, you may earn 8%, some other may earn 12% on this 100,000. This is called opportunity cost. And opportunity cost is also called as cost of capital. So my cost of capital on this investment is 9%. So obviously, I expect 9,000 benefit from accepting a project. Definitely. If it is not giving me 9,000, I will just reject the project. It must give me a benefit more than my opportunity cost. Therefore, you should always link up your opportunity cost in the capital budgeting decisions. Remember again, opportunity cost is not constant for all the companies or all individuals. It depends upon their earning capacity. It depends upon their risk, a response to the risk. Some people are risk averse. Some companies are risk averse, means they don't like to take risk. So their opportunity cost may be lesser. Some companies like to take risk to get more benefit. So their risk appetite, in a sense, they accept the risk. They say that if there is no risk, there will be no return. Therefore, we'll have to accept the risk. Their criteria is to accept the risk. So their cost of capital may be 12%. You don't need to worry as far as CMA examination is concerned, because the opportunity cost percentage would be given in the examination. But don't expect the same percentage in all the questions. The opportunity cost differs from question to question. Independent versus mutually exclusive projects. This is about having enough money to choose the projects from, or you have very less amount to choose from. I'll give you an example. Say, for example, I have $500,000. I have $500,000. Now, I want to take a franchisee of a food chain companies. Like I have in my hand KFC and McDonald's. From this $500,000, say if I go for franchisee of KFC, they are charging me $300,000. If I go for McDonald's, they are charging me 280. Clear? Now, I'm happy with both the projects. Both are profitable. I want to start both. I'm happy with both the projects. Both will fetch me profits. But is my investment or is my cash balance is enough to accept these projects? Definitely no. Why? Because what amount you have with you? 500,000. What amount is required here? 580. They are called as mutually exclusive projects. Means the acceptance of one project will automatically reject the acceptance of other project. Why? Because I have 500,000 with me, more than which I cannot contribute. This is the maximum amount I can contribute. But when I studied the projects require this money. So if I accept KFC, I will need 300,000. Yes, I can afford to have it. If I accept only McDonald's, I can afford it because it needs only 280,000 of investment. But if I like both the projects, as my amount available with me is only 500,000, whereas the requirement is 580, so I cannot accept. Then these two projects are called as mutually exclusive projects. Whereas if I have 800,000, I have 800,000, okay, and scenario is same. KFC, McDonald's, franchisee amounts 300,000 to 80,000. I'm happy with both the projects. Would like to go for both. Whether the amount is sufficient or not? Question mark. Yes, of course. Why? I do not have any capital shortage here. It is enough to accept both the projects. Therefore, these two projects are called as independent projects. These are called independent projects and these are called mutually exclusive projects. Independent projects, one project does not reject the acceptance of the other project because of adequate capital. Mutually exclusive projects, one product acceptance of one product will reject the acceptance of the other product because of the capital rationing problem. Capital rationing means no, we do not have adequate capital. So please remember independent versus mutually exclusive. In independent, we do not have any capital rationing issues. Means we have enough capital available to accept more than one project. In the case of mutually exclusive projects, the acceptance of one project will obviously reject the acceptance of the other project because we do not have enough money. That is called capital rationing. Capital rationing means the amount of capital is not enough. Therefore, we reject the other project. Mutually exclusive projects are those that have the same function and therefore compete with one another. That is because of not having enough money. Independent projects are those whose cash flows are unrelated and independent of one another. Means the acceptance of one project does not stop the acceptance of the other project. This is what we discuss about unlimited funds. There's no capital rationing. All independent projects have, have an option to be selected. But in the case of mutual exclusive projects, you will have, you know, not enough money. Therefore, you'll have to choose the projects which are highly profitable. Though the other projects are profitable, still you will have to reject it. Okay. So accepting, rejecting, and ranking approach, etc., etc., we'll discuss once we discuss the capital budgeting techniques. In the capital budgeting process, now onwards, please look for a cash flow. A cash flow in an investment decision can be an outflow, cash outflow, and cash inflow. Say for example, we are buying a machinery. We are buying a machine and we are purchasing a machine. When you purchase a machine, cash goes out. Therefore, it is called initial investment or cash outflow. Because you purchased a machine, you are selling additional 10,000 units. Because it's a new machine, you used to run with the old machine. Now that is replaced with the new machine, which is selling 10,000 additional unit. 10,000 additional units will give you a contribution of say $5 each unit. Contribution means it is the excess of revenues over your variable costs. So you are getting $50,000 additional profit. Okay. So you calculate this way that how much is your business is receiving, they are called as inflows. If this mission life is say 5 years, 5 years you will have inflows. Each year you will have inflows. In the first year you will have an outflow. This is a concept of cash flow. You will have an outflow in the first year and inflows during the life of the project. That is during the life of the machinery in my example. This cash outflow is also called as initial investment. Initial investment or cash outflow are same. Once the project is accepted, that is machine is purchased, you will get benefit from the machine using in the business. Therefore, the amount which you receive having this machine in our business is called inflow. These inflows you will have during the life of the project. So you will have 5 inflows, yearly inflows. These are called cash inflows. One outflow and 5 different years, inflows. One outflow, 5 inflows. So let us discuss about conventional and non-conventional cash flows. When you know about cash inflow, cash outflow, let us discuss about conventional cash flow, non-conventional cash flow. Let me explain you here. This project, this project requires $10,000 initially. That means year beginning. Year beginning, we want an amount of investment of $10,000. Cash is going out. Cash is going out. Therefore, it is an outflow. And having this investment in your business, and the life of the project is 8 years. 8 years you are getting cash in of 2,000 each year. These are inflows. So this project is giving us a $2,000 each year inflow. Say for example, you purchased a bulldozer and you rented it to a construction company for 8 years contract. The bulldozer cost is $10 million and they will be paying you say 2 million each year. Each year they will be paying you as a rental amount, to you. Or you constructed a big towers and which you rented to an office. They are paying you this much rent, fixed rent, and it is leased for 8 years. So there is one outflow and many inflows. But in the case of non-conventional cash flows, you will have some outflows in between during the project. See, here in my example, you have an outflow in the year beginning, that is zero. Zero means year beginning, and $8,000 in the fifth year also. Fifth year, you got it repaired or license is renewed, etc., etc. Therefore, you have an outflow again. This is called non-conventional cash flow. Means you need to pump in additional money during the life of the project. Unlike conventional cash flow. Conventional cash flows, you just invest only at the beginning of the project. It doesn't require further money. But in the case of non-conventional cash flows, expect an outflow during the life of the project again after the initial investment. Relevant cash flows. The amounts which I mentioned on the top, this 2000, 5000 in these two examples are relevant cash flows, means inflows. You get you get cash flows each year from your projects. So one outflow and many inflows you will get here during the life of the project. That's the reason why we have an outflow in 0 year. 0 year means year beginning, and rest all you will have during the end of each year. You will have cash flows. These are called relevant cash flows. Okay, and how to calculate these cash flows we'll discuss in detail. So the major cash flow components include initial investment, which is what we discussed here as an outflow. This is called, initial investment. Initial investment or cash flow at the beginning of the year. Okay, then operating cash inflows. These are the amounts you are getting in during the life of the project each year. Terminal cash flow. If your project is not successful and you took a decision to discontinue the project, say for example, project life is say 5 years, and this is first year. Initially, you invested say $100,000, expecting $300,000 or $30,000 in 5 years period. In 5 years period, and third year you want to discontinue this. No more fourth and fifth years. When you discontinue this, all your receivables will be sold off. Okay, your accounts payable will be paid. You will withdraw your working capital. Also, you will sell your assets here. You will not wait fifth year because there is no business after this. There is no business. So why do you wait? You sell this, assets. What amount of cash flow you get if a project is discontinued? That is called terminal cash flow. Else else project is successful and you are running here for 5 years. In the fifth year, the asset will be sold at a salvage value or something like that. What amount you are getting here is a terminal cash flow. See, this is an outflow. These are the outflows you will have during the life of the project. Inflows you will have during the life of the project, and there will be a terminal cash inflow that will be received either if you discontinue your project during the life of the project, or at the end of the project life, whatever the assets you remain with you that are sold, what amount you get, that is called terminal cash flow. So if the project is successful, you will have a cash flow of this amount plus a terminal cash flow. You will have more. If the project is discontinued in third year, this amount plus this amount, terminal cash flow. Clear? So as you know that there are three different types of components in cash flows. One is initial investment, which is required to accept a project. Two, operating cash inflows, which we get during the life of the project once the project is accepted. Terminal cash flow, this is the cash we get at the end of the project life period. So when you say cash flow components, this is an initial investment, and you have a operating cash inflows. And in the 10th year, I received an operating cash flow of 10,000, and as I explained you that I sold this asset or transferred to other project at a value of 25,000, that is called terminal cash flow. If you ask me that what is a cash flow in 10th year, I will say the total amount is 35,000, which includes operating cash inflow of 10,000 from doing the business, and by selling the asset I received 25,000. So the total amount received in the 10th year is 35,000. So please remember, initial investment is an outflow and the rest are all inflows which which you will receive during the life of the project. Operating cash inflows, terminal cash flows are inflows, and initial investment is an outflow. Remember, zero investment in zero or cash flow in zero means an outflow. Zero means January 1st at the beginning of the project. Need not be January 1st at the beginning of the project life. So to calculate initial investment needed to acquire an asset, and also if you have an old asset already with you, that the sale proceeds of old asset should be reduced from the initial investment. Operating cash inflows, we will calculate them. Terminal cash flows also will calculate them. So how do you find out the initial investment? Say for example, you are purchasing a new machine. You are purchasing a new machine, and what are all the amounts you are going to have on the the installation of the new asset. Let's see, cost of the asset which you paid to the seller of the asset. You purchased a machine, say for 100,000, and you brought this machine by paying say $5,000. So the original cost you paid to the showroom is 100,000, and you paid a transportation of say 5,000, installation cost of say 12,000, and also you paid an amount of 3,000 for training costs. This amount will be treated as an asset. Do not write transportation expenses. Do not write installation expenses. No, asset account debit, bank account credit. For 12,000, asset account debit, bank account credit. 3,000, asset account debit, bank account credit. What I mean to say is, until the machine is put into use, until the machine is put into use, until the asset is put into use, whatever be the expenses you incur should be capitalized, should be added to the asset value. Same like when you buy a car, the car showroom price is different and on road is different. You'll have to get your car insured, some internal fittings will be there, etc., etc. On road, on road, whatever the amount is there, that will go into asset value, and this will become depreciable base, that is 120,000. So you should charge depreciation on 120,000, but not the invoice value of 100,000. So you have to build up the asset value to 120,000, and 120,000 is eligible for depreciation, not 100,000. This is called depreciable base. 120,000 is called as depreciable base. Remember again, cost of the new asset, transportation, installation, and training costs will give you the total amount of a new asset which you invested in, and that will become depreciable base. That is, that amount is eligible for calculating the depreciation. So we call it as depreciable base. And if you have any old asset, the old asset fair market value is not to be considered, but how much money you received from the asset. Fair value or historical value of this old asset is not to be considered in investment decisions. How much you receive by selling the asset is important. So how much you received from selling this old asset should be received or deducted from this. Say for example, you received 18,000 from the sale of asset. So you need 112,000. Okay. Tax on sale of old asset. This I will explain you with profit, with loss. But at the moment you just think that there is an inflow of cash by selling the old asset is 18,000. Initial investment on acquiring the new asset is 120,000, but you have an amount of 18,000 which is received by disposing the old asset, and also having this new asset, your working capital will have an impact. You will have an impact because you are selling more goods, therefore you'll have to invest in more raw materials, so you'll have to buy extra raw materials. It should also be added continuously. You need to increase your raw materials on daily basis. This is towards inventory. And obviously you are selling more goods because your machine is producing more units, you will have more receivables. Say your receivables, your customer credit customers will increase by, say for example, 10,000, and you are running a new machine, therefore you may require some extra cash balances, you know, for any, operational expenses, etc. This is continuously required, so additional cash what is required to be maintained in your, you know asset. And as you are buying the inventories, therefore your supplier may give you extra credit. Say for example, increase in accounts payable is 7,000, so that has to be reduced. Accounts payable is to be reduced. So 112,000 from this calculation plus 5,000, 117 plus 10,000 increase in accounts receivable, 127 plus 3,000 in increase in cash balance, 130,000 minus increase in accounts payable 7,000. So 123,000 is the initial investment which is required to accept this project. Remember again, you will have three calculations. One is what is the total amount required for the new asset, what amount you received from the disposal of old asset, and what is the change in working capital. The maximum combination of all these three items will give you initial investment, that is cash outflow during the year 0. Remember again, this calculation involves three different calculations. It is a sum of three different calculations. One is the on-road cost, or the complete installation and training cost, including the original purchase price of the asset, less if you have any old asset, how much you received from the disposal of the old asset. And due to this new machine installation, our business will grow, therefore there will be some changes in your working capital, in inventory, accounts receivable, cash balances, and accounts payable. That should also be considered. And when you club all these three items, you will get initial investment.